am so excited about today's presenter, and y'all gonna have to forgive me because I was running my mouth, which is why we are a minute or two late getting started. Don and I haven't had a chance to catch up in over a month, and I've just missed him so. Also, he has a new, very handsome grandson. We had to talk about that too. He is precious angel. But in case some of y'all do not know, Don Rasmussen, he is a certified tax coach. He's our go-to guy when it comes to figuring out all of this stuff about PPP loans and EIDL and all of this craziness. And oh, wait, what's going on up there in DC? Don't have any idea. So if you need to know what's going on, like tax-wise, legislatively, that's going to impact your business, he's our go-to guy. And we are so appreciative of him taking the time out of his busy schedule to be here today. Don, it is your show. Take it away.
Thank you very much, Christy. And again, thanks so much for allowing us to be back on the ChiroHealthUSA TV program, I guess you'd call it, or webinar program. So first of all, again, last year we did a lot of webinars on PPP, as Christy referred to. Now we're going to talk, there's going to be one specific thing I really want you to pay attention to, because it's actually a carryover from last year, but they just changed the laws, and I think it's going to help a lot of DCs out there. But today's conversation is going to be about the Biden tax proposals. And I want to stress to you, of course, until it's law, these are just proposals. But the reason why in my conversations with the folks there at ChiroHealthUSA is just so that you don't get caught behind as to what that looks like, because we don't know, and I'll talk about this a little bit further, if they're going to make it retroactive to January 1st of this year. And there is some precedence of that happening in the past, which I'll share that in just a second. Just real quickly, if you don't know who Chiro Tax Pro and who Quartermaster Tax Management is, we specialize with DCs around the country. We do tax planning, tax credits, tax rebates for chiropractors. We have a great team of CPAs and accountants, but you don't have to change your CPA or accountant. We work with chiropractors from across the U.S. We understand the unique tax and financial situations that chiropractors face, and we love helping DCs. Matter of fact, last year, we found over $3 million in tax savings and tax credits, and we helped 156 chiropractors. Today, though, it's Biden tax proposal. So I expect you have a great CPA. We encourage you to go to them. But we want to give you an update on what that looks like. Again, this is our team. We're located in Charlotte, North Carolina. I'm not going to go into all that. So let's get to the key here, which is the Biden proposed tax policy. Now, this is what the information that his campaign shared during the election process. So it's always subject to change, but I'm going to go with you and walk through you fairly quickly what those are and how it may impact you and your family, maybe in a positive way, but also if it's going to impact you in a negative way. Now, I'm not going to be political here. I'm not here to pick any side or anything like that. These are just the facts. So what we're going to cover today is the current law versus the proposed changes. We're going to look at the tax rate changes. We're going to look at itemized deductions and how that's impacted. We're also going to look at tax credits, additional proposed changes. And of course, this is the bonus. They passed the Corona Bus Act here at the end of December, and there's some very valuable information under the Employee Retention Tax Credit. You'll want to pay attention to that today, because that could put a lot of money in your pocket if you qualify either for last year or this year. And then what to do next. So, of course, President-elect Biden tomorrow is actually, if you're not keeping up on things, is supposed to be the swearing in. But again, like I said earlier, these are not law yet. And imagine, even though there's a majority in the House and a 50-50 split in the Senate, that there's going to be some similarities to what he's proposed. There'll be I'm sure, some tweaking, some negotiating that goes on. Therefore, of course, all the details have not been laid out or set in stone. Most likely, the proposed policies must make it through the House and the Senate, as I mentioned earlier. And of course, additional details will be furnished as time goes on. When to expect enacted changes. So like I said, there is precedence, in the past, but with COVID, we witnessed a rush order process on enacting the CARES Act and FFCRA. So that happened very quickly. I can't say the same for the Corona Bus. It took them forever to get that done. But ultimately, because we saw, number one, that was one precedent that they pushed things through quickly, and their hatred of course, for the sitting President Trump, that may be given more incentive for them to push it through quicker. Normally, tax legislation changes take longer period to narrow down details before enacting. But again, with it being a Democrat run in pretty much all of the legislative branches. In addition, there's also rare to see retroactive changes, however, not impossible, as I'll show you here in a second. But you should consider being prepared if there is a retroactive tax law, meaning that it goes into effect January 1st. So let me show you here. So historically, if we look under the from back in 1993, we had the Omnibus Budget Reconciliation Act of 93. It was signed into law on August, and it was brought back retroactive to January 1st. The second one was the American Taxpayers Relief Act. It was just a one day, but it was made retroactive back to January 1st. But pretty much everything else since then has been in the subsequent year. So with the exception of FFCRA and CARES Act, which is just a matter of days. And again, it wasn't in the rearview mirror, it was just going forward. So let's talk about what those are. So tax rate changes, we'll walk through each tax rate change expected in 2021. Remember, of course, this is proposed law, not yet passed or enacted. Each change may include an overview, case study, client considerations. So right now, let's break it down here. So the corporate tax rate, I don't see a lot of this, but if you're a DC and you have a C corporation, or if you have a PLLC or an LLC that you are being taxed as a C corporation, you'll want to pay attention because your corporate tax rate is being proposed to be increased up from 21 to 28%. Currently, it's a flat rate of 21%. Of course, that came through the Tax Cuts and Jobs Act signed into law by President Trump. The Biden plan would increase it back up to 28%, which is a 33% increase in your tax rate if your tax is a C corporation or you have a C corp. Case study, let's say it's Phil's Chiropractic, that you are a C corporation with a net income of $350,000. You would pay an additional $24,500 in taxes because your tax rate on a federal level been 73.5. It's going to go down to 98. So an additional $24,500. So again, simple math. Just if you have a C corporation, you may want to have a conversation about maybe making a change from a C corporation over to an S corporation. Actually, we're working with the DC up in New Jersey, actually doing that this year. That was my suggestion, legal to entity change. Determine whether you want to make any changes, do that in 2021. Raising the corporate tax rate, like I said, the capital gains top rate. So that's going to change. So it was, of course, 0, 15%, or 20% as the current law stands. The proposal is that if you see a capital gains of $1 million, of course, it's going to go to 39.6%, which is almost 100% increase over the highest, which is right now of 20%. I want to pause here for a second. Just because they stated $1 million now does not mean it's going to be $1 million. It could be less than that. So the one thing, if you know about when it comes to elections, there's a certain group, whether Republicans or Democrats, that they're going to put their emphasis and focus on. And so in this particular case, the party, or the Democratic Party, was looking at saying, okay, how can we address the rich and to help the middle class or the poor, whatever the case is. And that was kind of their target. Again, it could be $1 million, could be more, it could be less. So just keep that in mind, but they want to raise it to 39.6%. Potential assumption in the deployment of this change would be to start at 39.6% for capital gains rate. And I'm going to show you an example of maybe it may be applicable to you if you're in a different phase of your life. So as an example, let me show you here the current law. If you have income married filing jointly of 0 to 80,000 in capital gains, you'd be taxed at 0%. If it's 80 to 496,000 is 15%. Anything over 496,000, it would be 20%. You can see that right there. Under the new proposal, going to married filing jointly, they're leaving everything the same except when you get to this 20%, it's going to be 496,000 to $1 million. You'd be taxed at 20%, $1 million or more at 39.6. Keep in mind if you are married filing separately or if you're a single taxpayer, we expect that to be cut in half. Case study, let's say after owning her practice for 25 years, Dr. Sally Field sold her practice for a net profit of $1 million. The gain from the sale will be taxed at the capital gains rate. So we're going to compare under the current tax law, her capital gains tax rate is going to be about $200,000. Under the Biden proposal, about $396,000. So an increase of $196,000 in long-term capital gains rate or taxes. You may, if you're looking at selling, and again, this isn't assuming they don't make it retroactive. You're going to want to do it in 2021. Don't wait till 2022. I actually have a DC that we're going to have this conversation as we get further on to the year of going ahead and selling his practice. He planned on doing it in 2022. He's going to want to accelerate that most likely. Consider gifting appreciated assets in future years. That's a more advanced planning tool. Individual tax rates. They're going to, for those who this is applicable to, and this is not all DCs. I can tell you that. I've talked to DCs around the country. But if you are a larger practice and falling in that highest tax bracket, you're looking at move from 37 to 39.6%. Not what you'd consider a huge increase, but it's an increase. Let's see here. Currently, of course, the tax rates are 10, 12, 22, 24, 32, 35, 37. These are the different thresholds. Now, there has been a lot of talk that whether or not it's going to happen, of course, on the campaign trail, you get different perspectives, that they may repeal the Tax Cuts and Jobs Act tax brackets. So that's another thing to keep in consideration. And, of course, we'll keep you informed if that was to happen. We're making an assumption, of course, that anything over $400,000, which was the campaign drumbeat, that if you made over $400,000, you're going to be taxed at 39.6%. If you're unfortunately when I say this, California is a beautiful state, but the highest tax rate out there. So the reality is you're going to be at 53, 54% tax rate out in the great state of California. So every dollar that you're making, over half of it's going to go to taxes. Of course, like I said, Joe Biden will not raise taxes on anyone making less than $400,000 was the theme of his campaign, and he's going to make big corporations pay their fair share. For single, married filing jointly, head of household, again, that generally is cut in half. So you're looking closer to $200,000, and that's what I'll show you here. So as the current law stands for single, your bracket stops at 518 or more when you're going to be taxed at 37%. Married filing jointly at 622,000, and as you can see here, they're going to consolidate this year where $400,000, the 35% tax rate is going to go away. You're going to go straight to 39.6%. All right, individual tax rates. Again, the Biden plan, they're expecting under this year that if you're $200,000 and you're a single taxpayer or a head of household, you're going to be, I beg your pardon, single will be $200,000 or more, and a head of household looking at $400,000 or more being taxed at 39.6. Next one is the elimination of the Social Security tax cap. So right now, as it stands, is $137,700 is the most you would pay your 6.2% Social Security tax on your dollars. Now they're looking at what we call a donut hole. So if you're in the high income earning, then you're going to pick it back up once you are at that $400,000 and above. So besides your tax rate going to 39.6%, now you're going to add on another 6.2% that you pay personally, but also your practice is going to pick up. So really you're at 12.4% tax additional because you're the owner of the business. So I'm not going to walk through all these details here. I just kind of gave you a summary of all that, the donut hole. And like I said, it's going to be 6.2% for you as the employee and 6.2% as the employer. So you got a 12.4% increase there. Again, just kind of a summary of everything I just explained. So suggestions here, you might consider switching to an S Corp from a Schedule C. So if you are a Schedule C, which I do find that quite often with DCs, you'll want to move over to an S Corporation. Consider deferred compensation strategy or other retirement strategies. Certainly can talk about that as well. Again, this is just a comparison based upon your income level, how much you pay. It really doesn't impact anybody that's under 400,000 or less based upon the proposal. Once you get above that, of course, now you're going to see an increase. And again, this is just the employee portion. This does not include the employer side of it as well. The 199A deduction. So this is called the qualified business income deduction, which in a nutshell just states that whatever falls onto your K1, as long as you, as a professional, as long as you stay below 321, you get a 20% deduction on your K1 or your profit of your practice. They're looking at starting that phase out. Some believe it's going to be the $400,000 figure, which really applies to you already because you're a professional. But again, that's all up for decisions as it gets to the legislation. So your pass-through income tax rate potentially could go from 29.6 to 39.6, just because that's that 20% decrease. So if you're currently seeing that 20% QBI deduction, that may go away. So now you're going to go up 10% in your tax rate on that money. This is a huge one. Now, you don't think too much about this, but I've worked with a lot of DCs. And so if you have a relatively average size practice and you have the value of your practice, you have the value of your life insurance, you have the value of your home and your investments, all these type of things, you need to pay attention to, because this could impact you because they are looking at a proposal of the estate tax rate changing, but also the exemption. So as it stands right now, you got $11.58 million per person for individuals, and of course $23.616 million for couples that you have an exclusion for estate tax and gift tax. So that just means that if you were to pass away and your estate was $10 million, of course there's no estate tax, or if you made some gifting, there would be no gift tax. Now what's been proposed is to roll it back to 2009, which is a pretty significant rollback, and that's $3.5 million per person. Now, you may think to yourself, I would never, ever hit this figure. You would be surprised once you add up all your assets of how closely you can come to that. And now you got to keep in mind here, we expect your assets to continue to grow. So depending upon how long this law is in place, it may come back and bite you and, or more importantly, your heirs, be that your spouse or your children or whoever you have as your heirs. They're also going to cap the $1 million gifting. So if you're generally gifting out to, like, for example, children, and let's say you gift a piece of property and it's worth a couple $100,000, you're capped at 1 million. And then of course, after that, you're going to go into that 45% tax rate. So again, it's a decrease of $8 million, the exemption per person. So it may or may not be applicable to you. Keep in mind, if you have family members, if you have parents that have a substantial amount of assets, keep in mind this could, again, that's going to flow down to their estate. So just always, like I said, just think this through here. It may be applicable. If not, disregard it. But I don't want you to be caught not knowing right up front. Again, estate planning is going to be a big part of this. Tax planning will be a big part of this. All right, stepped up basis. This is a huge one. And actually, I never thought I would see this proposal come up because it's a huge benefit to you. So I was just talking to a DC a little bit ago, right before I got on this call, who, invests in real estate, invests in stocks. And so what's going to happen, generally as the law stands right now, when you pass away, or let's say your parent passed away, whatever the case is, the date of their passing, you get what I call a stepped up basis. I'll give you an example here, pardon me, in a second for stock. But let's say, for example, your parents bought their house for $100,000 out in California 30 years ago, and now it's worth $2 million. Well, historically, or as the law stands right now, that let's say, for example, they passed away this year or next year, whatever the case is, they'd get a stepped up basis. So if you sold that house for that $2 million, you would not pay any taxes, or the estate wouldn't pay any taxes. But that stepped up basis, the proposal is for it to go away. So let me kind of walk you through it here. And I just kind of summarize everything. But ultimately, currently assets that pass on to heirs upon a taxpayer's death are valued at the current value rather than the basis when they purchased it. That's what I just explained to you. Stepped up basis means that the assets passed on to heirs are generally subject to much lower tax than they would be if they sold by original owners. And of course, the Biden proposes to eliminate the stepped up basis. Now, let me give you an example. So Tesla, it's the darling of the stock market, that and Bitcoin, I guess, these days. So I just took a chart here, and you can see here, this is the Tesla ticker symbol. In the 52-week low was $72 a share. On the 10th of January, it was $852. So let's assume that you, a year ago, which is actually March 18th, was when it was at $72 a share, you bought at $72. And if you did, congratulations, or anywhere close to that or even less. But let's say you bought 2,000 shares, you took 144,000. And again, assuming this is not inside of a retirement account, but this is money that you use outside of that. And let's say your parents did this. They purchased 2,000 shares back on March 18th. It's worth 144,000. They passed away today. And let's say we use that same closing price of $852 a share. It's now worth $1.7 million. So there's a long-term capital gain of $1.5 million. Remember, we talked about them changing the capital gains tax rates. So if you're selling your practice, or maybe in this case, you're selling, because of a death, there's a sale of stock. So the taxes on $1.56 million under the current law is zero because it's a stepped up basis. Remember, as I said earlier, when you pass away currently, it gets stepped up to the value, which would be the $1.7 million. But under the Biden proposal, you're going to pay taxes of $617,000. So pretty big, significant tax liability. Again, the states are going to get their part of that as well if you live in a state that has a long-term capital gains tax as well. So let's talk about itemized deductions. So in this case here, they're looking at eliminating some things and adding some things. So a lot of y'all have been penalized under the Trump tax law, which is the Tax Cuts and Jobs Act, under the SALT limitation, which is right now $10,000. So if you have property taxes, do you have your income taxes that you pay in your particular state? No matter what the figure is, you're capped at 10 grand. So they're going to eliminate that as a proposal. But what they're going to do is they're going to eliminate that, but they're going to put in a cap on itemization deduction to 28%. So if you are a high income earner, of course, that could have a negative impact, as I've shown here in this chart. And of course, if you don't itemize, it becomes a moot point. But most of my DCs itemize because again of the different taxes they're looking at. This is called the PEAS limitation. It's a gradual reduction of the deductions you're able to take. They want to reintroduce that. So just keep in mind there's some things you can do. We call it sandbagging or stacking, charitable contributions if you're charitably inclined. But I guess that there's some planning tools that can be put into place, but you have to be proactive. It's not something you do on December 31st. Retirement accounts. This is extremely important. I want you to tune in real quickly here. But the proposal is to provide a refundable tax credit for retirement accounts. Well, ultimately, what they want to do is they want to eliminate the deduction for your 401ks, your IRAs, and other retirement accounts. But in trade-off of that, they want to give you a tax credit. A tax credit is a dollar for dollar credits you would get. So instead of a deduction they want to give you a refundable credit of 26%. This will be a benefit for lower income taxpayers, but will result in lower deduction for higher income taxpayers. Doesn't mean you're going to not get benefit from doing these things. And of course, we encourage our DCs to do that. And part of that reason why I was working with a coaching group, and the leader of that coaching group shared something here a few weeks ago that only 14% of DCs actually sell their practice. So I was telling my clients that don't depend upon your practice to be your retirement account. You need to have something in addition to that. Case study, single taxpayer with 15% tax rate, 401k, it's going to be advantageous. You can see the chart here. They're going to come out $840 more under the Biden plan. Same way for someone making $80,000, they're going to be advanced there. Once you get to about $175,000, that's when you start losing some of the benefit of doing retirement accounts. So again, you want to lower your tax rate down, get your marginal tax rate is below that 26%. Increase retirement contributions may help reduce that tax rate as well. Again, to move on real quick, I'm going to just kind of blow through these here a little bit. So the tax credits they're talking about is earned income tax credit to make that available for those who are childless, workers over age 65, child independent care credit, moving that from $3,000 to $8,000, child tax credit if you have children and you may be eligible for this. They may phase it out based upon income, but it's move it from $2,000 to $3,000 per child, and an additional $600 credit would be allowed for children under age 6. So instead, if you have, I just talked to a DC who's expecting their second child this coming year. They have a 2.5-year-old, so they would get $3,600 for each one of those children in that particular case. First home buyers, they're looking at a $15,000 refundable credit for that. Renter credit. This would be for those lower income, of course, that make sure that your rent and your utilities don't exceed more than 30%. If so, they want to give you a credit to make up the difference. And this one here doesn't apply here, but Made in America credit, 10% advanceable tax credit for revitalizing existing closed facilities, retooling certain facilities, reshoring jobs, so on and so forth. Just a few other proposals. Real estate. Now, DC I just talked about wants to get into real estate, or maybe you have a lot of real estate. What they're looking at doing is, if your income is in the higher area, is eliminating your 1031 exchanges. So that just means that if, let's say, for example, and I'm thinking of one off mine, he had an apartment complex and he wanted to move it from an apartment complex to a beach property. That's called a 1031 exchange. He doesn't have to pay the gains on that property. He just transfers that over to another piece of property. They're looking at eliminating that, and also the opportunity zones that were created under the Tax Cuts and Jobs Act. So just keep in mind that if you are in real estate, this may negatively impact you. Again, there are plans to address those tax implications. You just have to give some forethought on doing that. Maybe that could very well, let me say this here, that could very well be your office. It doesn't have to be, rental property that you have outside of that. This could be your office. So if you plan on selling your office and rolling that over into some other commercial property, you may be penalized on this particular case. Again, if you're going to do any type of 1031s, I would do them this year. Or if you're going to make any contributions to an opportunity zone, I'd do it this year. Again, that's just based upon they don't make it retroactive. Now, I've covered everything that the Biden proposal has been. I know it's a lot of stuff in a short period of time. But I wanted to make sure I had enough time here to talk about Section 206 and 207 of the Coronabus, or as we refer to the Coronabus, the Coronavirus Omnibus law that was passed at the end of December. It's called an Employee Retention Tax Credit. Now, I'm not going to get deep in the weeds, but I want you to pay close attention, because for a lot of DCs, I was talking to one here in North Carolina early this morning, that are going to be eligible for this, whether that was in 2020 or 2021. So this is money in your hand. This is not way down the road. This is fairly quickly. So up until they passed this new law on December 28th, you weren't eligible for this if you received PPP money in 2020. Well, they eliminated that restriction. So that's why I want to get this information out to as many DCs as possible. And it's called the Employee Retention Tax Credit. I'm not, again, I can get all the PDFs if you want them to show you this here, but the credit amount. So it becomes 50% of the wages per employee in your practice. So I'm working with the DC right now in a northeastern state, and it's just the DC and 2 employees. It's 3 employees. So they're, in this particular case, and I know their details, they're going to be eligible for $15,000 because the maximum is 50% of $10,000, so it's $5,000. They're going to get $15,000 for 2020. And then I'll talk about 2021 in a second. So it's 50% maximum of 10,000 wages annually per employee. So it's $5,000 per employee maximum credit. Changes in the 2020, as I said earlier, you can do PPP and ERTC, but you cannot use the window that you use your PPP money. So if you use that over 8 weeks or 10 weeks, that does not come into the calculation. That's why it's important to make sure you have proper guidance on that. Employers can now include health care costs to claim the credit. So maybe you had to furlough your employees, but you continue to pay their insurance. I saw a lot of this up in like New Jersey. They continue to pay the insurance. That's something you can get reimbursed as well. But all other changes are consistent with the ERTC released back in March 2020, which again, I won't get deep in the weeds there, but there's specifics on that. So eligibility, businesses need to prove their business was there's two tests. Number one, shut down fully or partially by the government, by your particular state government, and most of my DCs are not going to fall into that category because in most states you are considered essential. So your state most likely didn't shut you down, maybe Kentucky being the exception to that. So we don't even look at eligibility 1 unless eligibility 2 doesn't apply. Eligibility 2 test is your gross receipt. So if you had an eligible quarter that you saw 50% drop or more, you would be eligible under the new under Section 206 under the new guidance. So I have Sal's Chiropractic here. In first quarter of last year, he was still up. Then of course Corona kicked in, and now his revenues dropped from $100,000 to $50,000. What happens is now he is eligible to take advantage of this tax credit, not just for that quarter, but every quarter, every subsequent quarter until he hits 80% of where he was at before. So you can see here, second quarter he's eligible, third quarter he's eligible, fourth quarter he's not because he hit 85%. So he has 2 quarters that we can take a snapshot and see which employees would be eligible for the tax credit. Now, why would that be different from one quarter to another? Let's say, for example, you furloughed in the first quarter or second quarter, and now you start bringing these employees back. That's where you'd be able to pick up a credit maybe you didn't have in the second quarter, but you have it in the third quarter. Again, I get a little deep in the weeds, but it's very, very beneficial for you. Kind of wrap up on 206. Again, it is a tax credit. If you have 100 or less employees, which all of y'all fall in that category, you'd be eligible for this. Test 1 is a shutdown operation, but like I said, most likely it's going to be 2. So in this case here, the 3 employees is Sarah, Jimmy, and Angela. And of course, Jimmy being the DC, Sarah and Angela being support staff. Sarah Jones, of course, in quarter 3, passed the test, or the practice did, met the criteria under test 2. They've never taken a credit in previous quarters. So her wages are $4,000. 50% of that's $2,000 to the DC, to the practice, I mean. Jimmy Johnson, who is the DC there, is $16,000 paid in that quarter, capped out at $10,000, if you remember that. So he's going to get 50% of that. That's $5,000. Angela, he got the credit in the second quarter. So that you can't get it in both quarters. It's one or the other, or totally that you could do in any particular year is $5,000. So he's going to get a $7,000 credit plus the $5,000 that he got for the subsequent or the previous quarter, a total of $12,000. Section 207. This is exciting because I think even more DCs are going to be eligible for Section 207 than they were for 206. And so kind of wind things down here. Here's a distinct difference. It's going to be 70% of wages paid per employee, a maximum of 10,000 wages quarterly per employee. So that's a $7,000 per quarter. Now it's only good for the first and second quarter of 2021, but you're going to be eligible for $7,000 per employee per quarter. That's $14,000 that you potentially, depending upon their income, you'd be eligible for every employee. So if you have 5 employees times $14,000, that's $70,000. This is like another PPP check. Now, I don't want to go into the second draw of PPP. I hope you've already gone to your bank or whoever your lender was before, but this is like another free money, and it's not taxable, just like the PPP money. Under the 207 versus 206, another, besides the great benefit that you get here, is that you only have to be, and it's been extended till the end of June, so it's only for the first 2 quarters unless they extend it for the rest of the year, but you only have to be down 20% instead of 50%. So if your practice revenues are down more than 20% in any given of the first 2 quarters of this year, then of course you'd be eligible. Again, I'm getting a little ahead of myself. Test 1, of course, is shut down by government. Test 2 is the 20% test here. So whether that's first or second quarter, again, just like my example earlier, once you exceed that 80%, then you're no longer eligible for that. So I'll give you an example of that here. So Sal's Chiropractic, 80% in first quarter, he's down. So now they're eligible. So they're down 20% or greater. So again, they're eligible for that one there. In second quarter, they're eligible because they're down 50%. So they're eligible. Third quarter, if they extend it, they would be, but based upon the current law, they're not eligible for this tax credit. And even in quarter 4, they hit 85%. They're still not eligible because it's not available for third and fourth quarter. It's only for the first 2 quarters. I know I sound like a broken record, but the reality is I believe that if this continues on with the corona, that we'll get an extension. That's just a theory. I think there's a strong, again, depending upon what part of the country and state, whether that be applicable. So again, get through all the verbiage here, give you the example back with Sarah, Jimmy, and Angela. Again, second quarter, they passed the test based upon the second criteria, which is a 20% or greater reduction. $4,000 in wages, 70% is $2,800. Jimmy's going to get $7,000 because, again, he's capped out at $10,000. And then, of course, Angela, even though she got the $5,000 credit in the first quarter, gets to get it in the second quarter. So that's now $12,000 or probably $11,300. So you get the $5,000 from the first quarter, the second quarter gets another $6,300. So total, that's $16,100 that was going to be coming back as a tax credit. Very, very exciting. I'm not, again, going into a lot of details. Another thing we are looking very closely at is the Family First Coronavirus Response Act. And the reason why is I'm talking to a lot of DCs as the year has gone on. We got into December, even into January, where either themselves have contracted corona or some of their staff has contracted corona. Again, high level, we can get more detail at a later date, but there's 3 levels under the FFCRA. There's the Family and Medical Leave Act, Families First Corona Response Act for emergency family and medical leave expansion, and then, of course, emergency paid sick leave. So there are more tax credits that are available to you if you meet the criteria. So let's say, for example, if you or one of your staff members are off because they contracted COVID, you get up to $511 per day for up to 10 days. So whatever your daily wages, up to $511. So that's another $5,100. If they're caring for somebody who has COVID, it's $200 maximum per day for up to 10 days. Then if you have, and this is probably hits a lot of staff out there, if you have children who are under age 18 and one of your employees had to be home with them, again, it's a tax credit. Now, the key to the FFCRA is that you would have had to pay them to be eligible for that. So if they went on to the furlough or something like that, that would not be applicable. All right, so what's the next steps? Ultimately, like I said, this is something that is hot off the press. It's only about 2 weeks old as far as the changes on the ERTC, the Employee Retention Tax Credit. The Biden proposal is about a hurry up and wait. But what I want you to do is be properly prepared and planning properly. And so you need to, the old saying is people don't plan to fail, they just fail to plan. I don't want you to be one of those who is at the mercy. Now, a lot of these things could change. It could be the dollar figure. It could be they repealed the Tax Cuts and Jobs Act. There's a lot of possibilities. But this is what was relayed to us during the whole election process. If you are needing assistance, you can contact us. You go to https://go.oncehub.com/ERTC. And whether that's for a free tax assessment or an ERTC assessment, there's no cost for us to do the assessment, and we'd be more than happy to do so. Listen, I have gone through a lot of information in a short period of time. Christy, are there any questions out there for me to answer?
The only question that we've had come up so far is, where can we download a handout? Because you went through a lot of information really fast, and they'd love to add that as a reference.
Absolutely. I would be more than happy. I can send these PowerPoint slides to you, Christy. And if you want to get them out to everybody, that would be more than happy to do so. So that would be my first thing, is I would just send you the PowerPoint presentation and you can send it out to everybody.
All right, everybody, be on the lookout. I'm going to get it to you shortly.
Yeah, and I do apologize. I just want to make sure we had enough time for any Q&A that might come up. So I want to be sensitive to our time that we have here. Again, I would say here, just watch, as the year goes on, watch the news, see what the different proposals are looking like. My goal would be to keep everyone in the know, so we don't have any unpleasant surprises. If there's any proposal of making it retroactive January 1st, there's certain things you can do. I mean, if you're fortunate enough to avoid the extra taxes in 2021, great. If not, we're pretty much, there's other planning strategies you need to consider as well. So again, thank you, Christy, for inviting me on here to share this. I know this, and you know this, Christy, that our DCs, it seems like it's a constant battle, and you work hard for what you have. I've had many DCs tell me, feel like I'm working harder but getting less because I'm having to pay more in taxes. Well, that's where we like to come along and keep you informed. And whether you go back to your CPA or you reach out to us doesn't make a difference. Our goal is to make sure that you are in the know. Over the years, I've owned 3 CPA firms, and this is a busy time for your CPA. They're getting into the craziness of getting tax returns done, and they may not have time long enough to slow down to tell you about this here. And they may or not be able to help you. It depends upon their expertise, but ultimately, at least and you're not blindsided later on in the year. So,
you are always such a wealth of information. Thank you.
My goal, like I said, is just to decipher it, put it in English, and get it out to the hands that desperately need it. I'm excited about the employee retention tax credit. We're actually going to be talking a lot about that over the next couple of weeks and really promoting that out because, again, this is money that, one thing I forgot to say about this here, even though we're not even, 2-3 weeks into the first month of the first quarter of this year, we can actually use your loss of revenue in the fourth quarter of last year to determine your eligibility for this quarter. So they put that into the provision as well, that we can actually take the fourth quarter of 2020 to make you eligible for 2021. Again, it depends upon how much you're down. And that's only that 20% test. So, and we can do what they call advances, get an advanced test. So it's putting money into the hands of the DCs out there, Christy. Like I said, your practice may be killing it and way up. It may be, pretty much at par what you were in 2019, and they have a lot of DCs that are still down. But wherever you fall, you just went through a tremendous year of 2020, be it good, bad, or ugly, and you may be eligible for monies that you're not even aware of. And then, of course, in 2021, 20% is not a huge drop, even in a normal year for some DCs. So I think there'll be more DCs that'll be eligible for that. So.
Well, thank you so much for taking time out of your busy schedule to be here. And thank all of y'all. Make sure that you can visit Chiro Tax Pro, powered by Quartermaster. They have a wealth of information when it comes to finding those tax credits for you and answering your questions about proposed tax changes, especially as we learn more in the next couple of weeks, I imagine, with it being tax season and months. Just a reminder, we have a new presenter next week, Dr. Christine Gertz. She's a chiropractor and a PhD, and she's going to be talking about data and how it's not just for scientists anymore. It's going to be a very interactive discussion where she's going to focus on how research influences chiropractic care and describe ways to harness the power of data in your clinical practice. I feel like we've been talking about data a lot lately in the last couple of months with presentations, because it is time for us to know what everybody else already knows about our practices. And she's going to tell us how to use that to our advantage. So I hope you'll join us next week. And then we'll be talking about if your EHR is creating any type of vulnerability to protected health information in your practice. So in the following week, and we've got a lot of exciting topics coming up in February and March, so stay tuned. If you have any suggestions for a topic you would like to see addressed in the second quarter, let me know and we'll get it booked for you. Everyone have an amazing rest of your day and a fabulous week. And Don, we look forward to having you back soon.
Thank you, Christy. Have a wonderful day, everyone.
Bye.
Have a great year. Bye-bye.